data pieces or anything else in between, please shoot them through, and then I'll endeavour to go and answer them at the end of this event. Well, thank you for everyone who's joined me today. I was looking at what's coming up next week. It's been a dearth of almost nothing this week. Big moves that we've seen in markets, particularly in bond yields and the US dollar. But there's been almost nothing to go and concentrate on. But that's going to change next week. And so I was trying to figure out how could I go and add some value to your trading stories out there and help you go and give a little bit better insight as to what to go and do next week, because the price signals, in my opinion, are going to be very, very difficult to go and give you strong signals, especially at shorter timeframes right now, because there's simply going to be so much to go and digest. So I thought I'd go and have a look at exactly what's been driving this dollar strength and the move we're seeing in US Treasury yields, because it's been really, really influential, especially in the FX space. So I've just got a presentation where I have a quick look at some of the factors behind that, and then we'll go and look at what's coming up both from an earnings and from an economic data perspective. It is going to be a huge week next week. Without anything to do, let's get straight into it. This first chart you can see on your screen. On the left-hand side is US 2-year Treasury yields, 10-year yields in the center, and US 30-year yields on the right-hand side. And I just wanted to go and look right now. In particular, you can see we've seen a rebound in yields across all different tenors over recent weeks. And you look down the bottom, you've got the rate of change on a rolling 4-week basis. And we're seeing some pretty chunky moves coming through at both the short end of the curve, so out to around 2 years, the belly of the curve out to 10 years, and then the long end of the curve for 30 years. And it's unusual to go and see an environment like this where we're seeing a big move higher in yields at the front end of the curve, accompanied by an equally or even bigger increase in yields further out. And there's some factors behind that, but it comes down to two very distinct things that I'll get to in just a moment. This here looks at the shape of the curves, just to go and reinforce the point that what we've seen recently is that it's been longer dated yields in the United States that have been rising faster than shorter dated yields. So on the left-hand pane, we've got what's called the US 2s 10s curve. So how do you go and come up with this particular figure for the scale? Well, it's simply the 10-year rate less the 2-year rate. And you can see it's been steepening recently, and up until the last couple of days, you can see there's been a bit of a jackknife higher. And that's been really interesting to go and see what's been behind that, because it's really been reflective, not so much of what's been happening with Fed rate cut expectations, but other considerations that we'll look at in a minute. On the right-hand side, just to go and reinforce that point, it's the 530s curve. So that's the 30-year Treasury note yield, or bond yield, less 5-year yields. And you can see that too has been steepening, albeit it's come off a little bit in recent times. So what we're seeing is that yields across the United States Treasury curve have been rising in unison. But broadly, up until the last couple of days, it's been longer dated yields that have been rising faster than shorter dated yields. Here's one of the factors why US 2-year yields are so strong right now. So this is the Atlanta Fed GDP Now forecast model. So it's not an actual model to go a forecast from the Federal Reserve or the Atlanta Fed, but what it's showing right there is that based on a whole bunch of economic data that's been received for the third quarter and some market indicators that go into this model, it's suggesting that economic growth in the United States in the September quarter was 3.4%. Now, that is incredibly strong growth, even from a historical standpoint. And you can see where the blue chip consensus, so that's where forecasters have been expecting growth to go and land for that particular quarter. And you can see that they've been forced to go and constantly revise higher their expectations because the growth has simply been so strong. Indeed, we're coming off the back of a June quarter growth rate, a seasonally adjusted annual rate of 3%. This is suggesting it's going to be even faster in the third quarter. Now, we'll get an update on that. The data release will come out later next week. But what we're looking at more broadly is that green line, it's at levels, growth pace, where you'd normally expect to go and see unemployment coming lower and inflation going higher. And that's what's got markets a little bit concerned about the cuts that are being priced and having to go and pull some of that back because it's well above what is called the potential growth rate here. The US, if it comes and lands at 3.4%, about 1.4 percentage points above even the most optimistic estimates out there. And so that's one of the factors behind what's been driving the short end of the curve. Another factor is what's been going on when it comes to economic data. So this is Citi's Economic Surprise Index, and in the blue and the top pane is economic data for the United States. Now, how to read this is that it's an aggregate measure of how economic data across various regions prints relative to market forecasts. And when you've got a reading above zero, like we're seeing in the United States right now, it indicates that more economic data than not is topping expectations. So not only are we seeing the US economy growth very, very strong, but even with higher expectations coming in for what's going on in the economy, the data is continually beating at this point in time. Indeed, the rate of beats coming through is the highest level that we're seeing in April of this year. And those who can remember back to that time, the Fed was not talking about cutting rates at that particular moment. It was all about patience, and we can see at the moment the growth is strong and the data continues to surprise on the upside. Just want to go and show as well that there has been some moves in other markets as well. So you can see Chinese economic data is shown in red in the middle pane, and Eurozone data is shown in grey in the bottom pane. And whilst they are net still producing more data disappointments than positives at this stage, the rate of disappointments has been narrowing in both. So expectations in those particular economies have been lowered over the course of recent times. And eventually that will go and make it easier to go and beat expectations. And then that could go and mark one of those contrarian signals for a potential turnaround in both the Chinese yuan and also the euro. But we're clearly not at that point just yet. Looking at this here, this is just looking at what's going on when it comes to market pricing for Fed rate cuts. On the left-hand pane is what markets are anticipating over the remainder of this year. There's around about 44 basis points of cuts that are currently priced. So that still implies the likelihood that we'll get at least 2 25-pointers, but it's not deemed a slam dunk at this point in time. But you look at where that's coming from. Around about a month or so ago, markets had the idea that we'll get a 50 with a strong possibility of another 50 as well. So we've seen a really dramatic pullback in market pricing for what the Fed is likely to go and deliver when it comes to rate cuts. The right-hand pane is simply the Fed funds curve looking out from this month out to the end of 2025. And you can see now around about 135 basis points worth of cuts that are priced. That's 5.5 25-point cuts that are now priced in. And you look back to what we're looking at in the middle of September, well, that was 9. So there's been a really, really dramatic decline in the scale of rate cuts that are expected. And that's because the data has basically forced the hand of markets to go and say, well, the Fed's not going to have to go and be aggressive as we initially thought. Here's another factor which is definitely starting to go and get attention when it comes to longer dated US yields. And keep in mind of this because I'm about to go and explain, it's been very, very influential on currency market movements in particular recently. So this is just simply the US federal debt load. And sitting now above $35 trillion. And you can tell by the pace there that it has been increasing pretty dramatically. You can see in that bottom pane, the rolling 12-month increase is still north of about $2.3 trillion. So if you want to go and have an understanding as to why the US economy is so strong at the moment, well, the fact that we're running such massive fiscal deficits is a big factor behind that right now as well. And you can see, despite the economy still humming along pretty well, there's no sign whatsoever that there's any decline or even a moderation in the amount of new debt that's been issued and outstanding debt. So that is something that's really capturing the attention of markets right now. And then we have the US election. Now, this information comes from the Committee for a Responsible Federal Budget. It's supposed to be a bipartisan a group that's basically independent. And what they've done so far is go and have a look at the policies that have been announced by the Democrats and the Republicans. What would be the increase in the debt load for the United States at the federal level if those policies were introduced. And you can see here when it comes out between 2026 to 2035, these particular figures, based on what Kamala Harris and the Democrats have put out, the central tendency is to go and see that increase by $3.5 trillion. But you can see down the bottom, Donald Trump, the central tendency there is 7.5 trillion, with the upper end of estimates sitting at $15 trillion over the course of a decade, on top of that level that I was just looking at before. So you can see at the moment that Trump is likely to go and run more reflationary, more expansionary budgets than will the Democrats if he gets into office. And of course, the polls and the betting markets have seen him flip into the favourite. And to me, that explains a lot of what we've seen in the US Treasury curve and the increase in yields further out the curve, beyond sort of 2-year yields, 5 years, 10 years, 30 years. They're looking at the polls, traders, they're looking at the betting markets, and they're saying, well, at the moment, if Donald Trump gets in, and especially if we see a red wave through Congress, so they manage to go and retain the House and then flip the Senate, potentially it could really open the floodgates when it comes to debt issuance and potentially what that would go and mean. Now, the thing that normally comes about when you see big fiscal deficits and big trade deficits like we've seen being run at the moment in the United States is that typically what would happen is that your currency would go and weaken. Twin deficits normally would go and see this economy needs to become more competitive, it needs a lower currency, that would go and weaken it. But it's a really, really unique scenario right now because that's not actually taking place. Instead of acting to weaken the US dollar, what it's doing is actually helping to go and boost it. How do I know this? Well, let's go to some of the live charts. Some of you who've seen these before with me would know that I pay pretty close attention to correlations. I like to go and see what potentially is moving things around. Now, the left-hand pane here is looking at the correlation between US 2-year Treasury yields, and the right-hand pane is the correlation with US 10-year Treasury yields. And it's all based off currency market movements. So what we're looking at here is the DXY, the Japanese yen, the the euro, and Aussie US. And you can see here just the scores are really, really, really strong. So you can see DXY for the 2 years, 0.9, 0.92 for dollar yen, 0.83 for the Chinese yuan. And when you look at the euro and the Aussie, given the way that the convention is, how they're expressed, at minus 0.86 and minus 0.93 down the bottom here. So really strongly inversed relationship over the past 20 days, which is designed to go and give you a sort of a hint as to what's been driving things potentially over the past month or so. Really, really influential. But then when you look at what's going on further out the curve, well, the correlations become even stronger. You can see here over the past month, the DXY at 0.94, dollar yen at 0.95, dollar yuan at 0.84, euro US sitting at negative 0.92 and negative 0.94 for the Aussie. So even stronger relationship with the back end yields in the United States. So what's that saying? It's like, well, okay, basically what we're seeing at the moment is that the dollar, when yields are rising, is strengthening. That's basically the read through from that. And in particular, looking at what's going on, it's longer dated yields that arguably are slightly more influential right now than what we're seeing when it comes to shorter dated yields, but it's all feeding through to dollar strength at the moment. So what does that mean? Well, to me, you need to go and try and assess what direction US yields are likely to go and travel next week. And as I'll discuss towards the end of this live event, there's simply so many things out next week that it's going to be very difficult to go and put your finger and say definitively, I think it's going to go and do this. But all the reaction that you see in markets next week and up until the election, until we know the result, is going to be put into context of what the polls are suggesting. If the polls are suggesting that Donald Trump and the Republicans will go and take control of Congress, what would likely happen if we saw any stronger economic data coming through in the United States as well? It would likely go and really exacerbate the moves we've seen in yields and the dollar over the past month or so. But alternatively, if we go and see the data print a little bit weak, any reaction we see in markets might be fleeting in nature because it will revert back to thinking, well, that's the past. The future is what's going to be driving the fiscal side of the equation in the United States. Alternatively, if we see that the Democrats start to go and claw back some of those losses at the moment and maybe flip some of those swing states, then potentially we're going to talk about a reversal of these moves we're seeing in the dollar and yields. And then if we see any strong data coming through, potentially it might be faded a little bit. That's just the way the markets are perceiving the two candidates and their policies right now. So to try and give me a sense as to what direction yields are likely to go, well, one way you can go and do that is using Treasury futures. Now, just like any other market at the moment, what this is looking at two-year Treasury note futures. So basically a way to go and play expectations on how the price for two-year Treasury yields or two-year Treasury notes will behave. So when the price is going lower, it implies that yields are going higher. So you can see this is the two-year note, and you can see this here is very influenced by Fed rate cut expectations. It's been calendar adjusted as well to go and better reflect where volume is going through these markets. And you can see here from a technical perspective, to me, it's very respectful of levels, and that's why you can get a guide as to exactly what might come through when it comes to some of the directional risks moving forward. I'll get you to have a look here. So we're seeing this bearish break taking us through the 50-day moving average, then a period of consolidation, a brief dip below the 200-day moving average, came back above, and that was on the back of some pretty strong economic data. And then what we're seeing since is that the price has gone and tested this and then broken through below this 200-day moving average. And you also have this horizontal line, which was acting as support, which now may be acting as resistance as well. And you can see after breaking through on Thursday, we saw the price go up, test that level, and then come back lower. And so that to me is telling me that there are people that are trading this market right now, and in an attempt to go and make a sustained push lower for yields was rejected. Now, it hasn't been any real movement today. I wouldn't expect so today in Asia. But to me, that's a really key level to go and watch. And you can go and look at this chart on any of the platforms that's available, or you can even go and try and look at it from a yield perspective as well. But when I'm looking at two-year Treasury notes right now, until we go and see a potential break back above this 200-day moving average, it's a sell and rallies play, which points to the potential for higher yields ahead. Looking at some of the other details here as well from a momentum perspective, we've seen that the very, very minor divergence between price and RSI 14 broke down, and you can see here now back on terms again. So at the moment, momentum has been entirely with the bears, but there's signs ever so slightly now that we might be starting to go in bottom. You can see that too coming through in MACD. Probably of more importance, given what we've been talking about with the influence that longer dated yields have been having when it comes to movements in currency markets, this is the 10-year note future. So this is the 10-year Treasury, a futures contract, and you can see here, like the 2-year note, it's been trending lower at this point in time. A few interesting things happening here though. So it's broken the 200-day moving average already, pretty convincingly, but then the last couple of days, we've just seen that, it's dropped off, and then we saw a decent bounce yesterday, but again, couldn't be sustained. Today, we've opened a little bit more bid as well. But from a momentum perspective, yes, it's been one-way traffic with a few, blips in between. But you can see here, RSI 14, from the sell-off when it began, we've just gone and broken that. So that, to me, is one little signal that potentially the dynamic when it comes to momentum is starting to change. The bears were very much entirely in control, but now we're seeing this break of RSI 14 from oversold conditions. And so it suggests that the market's run a little bit too hard, too fast. So it wouldn't surprise me at all to go and see a pop back up towards this horizontal level, which acted as support in the past, now might act as resistance, or even the 200-day moving average. This level here is a minor one. So it's more probably about the 200-day moving average you should be paying attention to. Just a reminder as well, those who are listening in and watching, please, if you've got any other markets you want me to go and focus on in the currency space, the equity index futures space, commodities and the like, and answer any questions at the end if they come through. Let's go and have a look to the week ahead. So that's from a technical perspective about how things are shaping up in rates world, which we know has been very influential when it comes to movements in the currency markets. Then, look, I don't have an edge at all when it comes to anything individual stock. I'm not a stock analyst, but all I look at this, and this is the earnings calendar coming up next week, and it's based by market cap. And just look at some of the names at the top of the screen. Apple, Microsoft, Google, Amazon, Meta. Now, these are huge companies. They're all benefactors of the AI hype and the trade that we've seen over the course of this year. And they're all going to be reporting in the space of a few days. You can see here, we've got Microsoft kicking things off for us here in Asia on the 30th. Then we have, no, it's on the 29th, sorry, is when Alphabet will report. Microsoft on the 30th, and then Apple. Meta's on the 30th as well. Apple on the 31st, along with Amazon. So it's just going to be a huge week, and anyone trading equity index futures needs to be aware about the gap risk that we could go and see in futures markets around these events, because it's so difficult to anticipate. Just look at what happened with Tesla's earnings report that came out after market close on Wednesday, up 22% yesterday, and it was very influential. Now, Tesla is a tiddler compared to some of the names on this list now. So if there's any change, yeah, you've just got to be aware that, yes, they tend to go and impress, but that's not always what it comes down to. A lot of the time it's about the amount of capital that's being deployed into to go and fund this AI path that they're going down as well. And at some point, markets are wanting to see clear evidence that artificial intelligence and the investment that's being put in is going to go and deliver big windfalls when it comes to revenue growth. At this point in time, we're still not at that point, but that's the risk with these names. So just keep an eye. Anyone trading those needs to be aware of it. And just simply because the sheer size of these names and the influence they're going to have on the S&P 500 and of course the NASDAQ 100, it means that they too could go and influence some of the movements in other asset classes like like FX. I wouldn't say rates markets, but certainly FX markets as a risk gauge, they could be pretty influential. Let's have a look at the data calendar. It's going to be incredibly busy next week. So like we've seen quite often, we go and get a slowish start and then it becomes really big towards the end. Most of the stuff at the moment, the Treasury funding announcement. This is a quarterly announcement that comes out from Treasury, and basically it's where it goes and says, here's what our borrowing is likely to go and be over the coming quarter. And given what we're talking about with uncertainty about the fiscal trajectory of the United States and the election, keep a close eye on this, because if it's a larger total than expected, the reaction could be quite pronounced in Treasury markets. And I would say that if it's a bigger than expected total, you're going to see yields go and blow out even more. Just to go and make things even more interesting during the week as well, we have a variety of different debt auctions as well, primary debt auctions in the United States, 2-year note auctions, 5-year note auctions. So it's going to be a really important week when it comes to trying to go and gauge market appetite for bonds, where yields are at the moment, given the uncertainty about the fiscal side of the equation and what's going on in the economy. On that very matter, so things like a lot of the data here is going to be very second fiddle. So I'm not going to go and spend too long on some of these releases that are coming out. You can see here, house prices in the United States is not going to go and move the dial. The consumer confidence report is a minor one, but keep a close eye on sentiment towards the labour market, because that's what the markets are most twitchy about right now. And there's a labour market differential indicator in that. You'll read about that if you follow it. And that's going to be really important, because sentiment about the jobs market flows through to spending and investment decisions. And if there's people feel more negative, it's likely to go and see the odds of a further rate cuts from the Fed potentially going increased. JOLTS, job openings, so the number of job openings, very wide margin of error, but the markets still pay it respect to it like it's gospel. So you can't go and dismiss that as well. That's going to be really, really important to keep a close eye on as well. All the times you can see here are Australian Eastern Daylight Time. You can see a 7-year note auction in the United States as well on Wednesday. And then you also get really important other events coming out, like Australia's quarterly inflation report. Trimmed mean is the number to go and keep a focus on right now. The RBA's forecasts are centered around an increase of 0.8%. If it was to be that or lower, obviously the conversation is going to be potentially will the RBA be able to go and cut rates this year. But just simply with the strength we're seeing in the labour market at the moment and other factors out there, it just would be too soon, too preemptive to go and cut the RBA in my perspective, even if we do see a slightly softer than expected trimmed mean reading. So keep a close eye on that. 0.8, that would go and match what we saw back in the prior quarter as well. There's other things like GDP preliminary reports that come out from parts of Europe and the like. And then you can see here some of the European inflation reports going to be very, very important as well. You can see also German GDP, the flash index, but it's not really going to be the thing that moves markets. It's going to be what happens when it comes to the bloc, the Eurozone bloc, and especially around inflation. So you can see here over the course on Wednesday, we get the Eurozone GDP flash estimate coming through. And then in the United States, the ADP employment report, which I think is going to be equally as important as payrolls when it comes to giving us signals. It's been a very reliable indicator this year as to what we're likely to go and see come and take place in private sector hiring. So don't dismiss that potential release. It could be very influential. You can see here in the United States as well on Wednesday, we get the advanced Q3 GDP report to go and see whether that GDP now forecast of 3.4% is on the money. Keep a close eye on the PCE deflator, the core PCE deflator in particular. That's the Fed's preferred inflation measure. You can see here German inflation as well coming through in the early hours of Thursday morning, our time. And then elsewhere, retail sales in the likes of Japan, not likely to go and move the dial. You can see here in Australia, another important release on Thursday is going to go and be we get retail sales, we also get a broader household spending indicator, which is going to give us a really good insight as to the likely strength of household spending in the third quarter. So we're actually going to get a bit more of a guide when we never used to get that. So that's going to be very influential when it comes to expectations of the RBA as well. So keep a close eye on Thursday. That will be big. The PMIs in China as well on Thursday, very big in terms of trying to go and see if there's any early evidence that the measures that are being put in place are starting to go and turn things around there. Probably a little bit too early, you would imagine. BOJ, we get quarterly update to forecast as well, just to go and add to the mix. Very, very busy Thursday. Not likely to go and change rates. Indeed, it's very, very unlikely at this point in time. But keep a close eye on the press conference as well. Ueda, he is likely to go and generate the most volatility given what he says to the media. So that's the one that you'll be paying pretty close attention to for that particular event. European flash inflation on Thursday evening our time. Very, very important. We know that ECB market pricing right now is around about 50-50 when it comes to whether the ECB will deliver a 50 basis point cut in December. The trends in this particular figure could be very influential in determining not only what happens with that pricing, but also in euro dollar. Just to go and make things even more interesting, on Thursday evening our time, we're going to get employee costs. So this is a really, really good gauge as to what's going on when it comes to wage pressures in the United States. And then we also get the Fed's preferred inflation measure, the core PCE deflator on the monthly series, along with income and spending data. So again, very, very, very important numbers. Just in a week where it's remarkably busy. So it's going to be difficult to go and, but just remember that the bigger events, the further through the week we go, the bigger the events become, in my opinion. And then we get to Friday. And look, I'm just going to skip straight to the piece of resistance, the one that is very, very, very important and will go and be the real primary driver before the election. And that's the non-farm payrolls report for October. If you think back to what happened in the September report, it was a blowout. Household survey, payrolls, unemployment, underemployment, wage growth, every single metric beat expectations, and it really explains why we're seeing this big recalibration in rate cut expectations from the Federal Reserve. So whether we go and get a follow-up like that, if we do, it's going to be carnage in the US Treasury market. I would be surprised we don't see some really big moves, particularly not only at the front end of the curve, but at the back end of the curve, given the implications if we do see a Trump presidency and a red Congress as well, held by, or houses being held by the Republicans. So that's going to be the real kicker. In my opinion, the market reaction right now is always at this point in time, usually driven by the payrolls figure, but it's the unemployment rate, which is far more important to the Federal Reserve. So if they two diverge, then what that would tell me is that the opportunity would be to go and fade the reaction in the payrolls report in favor of what the unemployment rate signal is, because that's what the Fed cares about more than anything else. And just to go and wrap things up as well, you can see here we have ISM manufacturing PMI, again another release that on its own would normally go and generate significant volatility. That comes after the payrolls report on Friday. So it's a pretty big week out there to go and digest, and hopefully that makes sense. So just remember that what we're seeing right now in the FX space is that it's been very highly influenced by what's been going on with Treasury yields. So how the data prints and the reaction in Treasury yields is likely to go and move FX markets around. When it comes, of course, to the other earnings reports as well in the United States, anyone who's trading the NASDAQ or S&P 500 in particular needs to be really acutely aware of those reports when they come out. Every one of the reports will come out after market close, depending on the day. And then when markets go and reopen, we'll see often some pretty big gaps in those markets. So that is the playbook for the week ahead. I can't see any questions that have come through, but those of you who have joined me today, thank you so much. And I look forward to going and catching up with you this time next week when I'll be in Sydney. Hope everyone has a fantastic weekend. I'll see you then.